As of March 25th, 2025, the U.S. market is facing a turning point. The timeline for the current round of tariff actions is April 2nd, which the Trump administration is calling Liberation Day. On that day, reciprocal tariffs are expected to go into effect against countries with the largest trade surpluses with the U.S. And according to the Wall Street Journal, this includes nations such as China, Mexico, Taiwan, Vietnam, and India, part of what the White House informally calls the Dirty 15. The intention is to level the playing field and pressure trade partners to lower their own barriers. On March 24th, reports emerged that the Trump administration plans to narrow the scope of the tariffs, opting for a more targeted approach rather than broad sector-wide levies. This decision suggests that industries such as automobiles, semiconductors, and pharmaceuticals may be exempt from the upcoming tariffs starting April 2nd. There were also hints that certain countries might be excluded. In response to the uncertain tariffs, the Federal Reserve announced last week that they expected 2 rate cuts in 2025. But this past Monday on March 24th, the Atlanta Fed President Raphael Bostic said that now he only expects just 1 rate cut in 2025. Tariffs will lead to higher costs, which will lead to inflation, and to control inflation at a 2% target level, the Fed will keep the interests at a higher level rather than cutting it. Bostic cited uncertainty around inflation and tariff policy as a key reason to keep the interest rate higher, but other reasons also include cautious consumer confidence, which fell to 72.9, below the recession warning level of 80, and a slight slowing down in job growth. The economic uncertainty from tariffs is also leading to businesses expecting weaker earnings. 1 week ahead of April 2nd, there are 3 possible paths that could happen with the tariffs and the impact on the stock market. 1. Targeted tariffs proceed, no sectoral levies. This is currently the base case scenario. The White House is expected to go forward with reciprocal tariffs only on countries with the largest trade surpluses with the U.S. This means industries like semiconductors, autos, and pharmaceuticals are expected to be exempt for now. In this case, inflation might have a slight upward pressure, but risk is modest and would stay manageable. So this would allow the Fed to stick with its plan for just a single interest cut later in the year. This would mean a minimal earnings impact in most sectors, so the S&P 500 EPS might hold around 270 for 2025. While the export-heavy firms may see some margin erosion. If consumer strength continues, supported by real wage growth and jobless claims below 250,000, the stock market could stabilize or even climb further. The second scenario is broader sectoral tariffs are added. This is the worst-case scenario. If the administration surprises markets by adding tariffs on entire industries, companies like Nvidia and Tesla could face significant cost increases. For example, the chip and auto industries rely heavily on components from Taiwan, Mexico, and Canada. This would likely spike inflation and force the Fed to reconsider any interest cuts. This may actually even return the talks of interest rate hikes. With EPS forecasts already under pressure, down to 11.5% for 2025 from 14.1% in December, the S&P 500 EPS might fall to $230, and this might lead to the S&P 500 index lower than its low on March 13th of 5521. Third possible scenario is that tariffs are delayed or softened even further. This is the best case scenario. If April 2nd passes with a lighter than expected tariff regime, or if negotiations with key trade partners like Canada or the EU make progress, markets are likely to rally. The relief could be strongest in tariff-sensitive sectors like semiconductors and autos. A softer approach would reduce inflation concerns, and the Fed may cut rates even more than once this year. And the S&P 500 EPS might stay above the $260 to $270 range, depending on the sector. In the best-case scenario, the market will bounce back up and all the stocks in our portfolio will benefit. And the opposite is true for the worst-case scenario. But in the base case, the tariff path could impact our stocks in different ways. Let's take a look at each. Nvidia appears to be in a relatively strong position in the short term, as the latest reports suggest that chip-specific tariffs will not be included in the April 2nd rollout. And as a result of that, the stock rose 2.1% on March 24th and is looking to stay relatively flat on March 25th. This rise on Monday reflects investor relief over the delay in semiconductor levies. And if the base case scenario holds, Nvidia's stock is bullish since, as we explored in the last video from the GTC conference recap, the fundamentals and the short and long-term outlook are strong. After its 9-week losing streak, Tesla rebounded sharply by 11.9% to close at $278 on March 24th and again stayed flat on Tuesday. The rally was driven in part by optimism surrounding the company's full self-driving rollout in China and a speech by Elon Musk that reassured employees and investors about the company's vision. But the first quarter sales expectations have been revised down to around 360,000 vehicles from the earlier 414,000 estimate, and BYD sales have taken over Tesla sales for the first time. And although the new base case tariff plan exempts the auto sector, Tesla's exposure to Mexico and Canada for parts and assembly remains a risk if sectoral tariffs return. We'll have to monitor Tesla's delivery data due on April 2nd and reassess the outlook on Tesla. Vistra and EQT, both energy companies, may benefit indirectly from new U.S. tariffs on buyers of Venezuelan oil. If the U.S. tightens global oil supply through these measures, it could push prices higher. Vistra's stock rose 3.35%, while EQT's shares rose 2%. EQT in particular could benefit if LNG exports from the U.S. increase as a result of global realignment. Regardless of the tariff path, defensive stocks like energy is a good investment during inflationary risk periods, and the energy needs from AI and quantum isn't going away. Palantir is relatively safe from tariff shocks as it operates primarily in data analytics and AI-driven contracts. Its March 24th close at $96, up 6%, and stayed flat on Tuesday, March 25th. This signals confidence in its continued access to federal contracts and government spending as mentioned in the last video on Palantir. If trade tensions drive more reshoring or national security spending, Palantir may even benefit. I plan to continue on stocking up on Palantir with dollar cost averaging. IONQ, Rigetti, and D-Wave Quantum all rose on March 24th and remain flat on Tuesday. They're likely to benefit from federal R&D support and industrial reshoring. And as the U.S. increases domestic investment in critical technology areas to reduce reliance on foreign suppliers, all three of these companies will continue to rally. From a technical standpoint, the S&P 500's 10% correction in under a month, from 6144 on February 19th to 5521 on March 13th, was sharp and fast, which is often a sign of panic-driven selling rather than structural weakness. March 24th relief rally may be a sign that the oversold condition has been corrected, but there are also warning signs of a recession, such as the Consumer Expectations Index dropping below the recession warning threshold of 80, job creation slowing although still positive, uncertain business confidence, household savings rate below 4.6%, much lower than the 10-year average of 7%, policy uncertainty, and the S&P 500 EPS forecast growth down from 14% last year to 11% this year. But a recession forecast is not black and white. You have to think of a recession as a probability. And within the next 12 months, the recession forecast on average by top analysts and economists is around 30%. For instance, JP Morgan's chief global economist Bruce Kasman has put a recession risk probability at 40%. Goldman Sachs forecasts a recession probability of 20%. Deutsche Bank estimates a probability of 43%. And the New York Federal Reserve's DSGE model forecasts a 33% probability. So in summary, the market is going to react to how the tariffs play out on April 2nd. Currently, the base case is that tariffs will be on specific industries only, which will alleviate the pressures on all of our stocks that we're watching in our portfolio. But even in the worst case scenario, Nvidia, Palantir, Vistra, EQT, quantum stocks all have strong fundamentals, so don't worry if we do see a decline. Hold on to them because they're not weak companies and will survive whatever comes in the next 12 months. Thanks for watching.